Hello everyone. Today, we are going to talk about a common tax planning strategy called income splitting and how the attribution rules can affect it. If you are a high-income earner and want to lower your family's overall taxes, this video is for you. What is income splitting? Income splitting is when you shift part of your income to a family member, usually someone in a lower tax bracket, to reduce your overall family tax bill. However, the government has rules in place, called the attribution rules, that limit how much you can benefit from income splitting. So let's go over some strategies you can still use. Number 1. Income splitting with your spouse. Invest your spouse's income. If your spouse earns less than you, have them save and invest their income in a separate account. Any income they earn from these investments will be taxed at their lower rate, helping reduce your overall family taxes. Income on income. Even if you give your spouse money, the initial earnings will be taxed on your return. However, if your spouse reinvests the earnings, the future income from those investments will be taxed in their name. Example: Mrs. Smith gives $100,000 to Mr. Smith, who earns $5,000 in interest. That $5,000 is taxed to Mrs. Smith, but if Mr. Smith reinvests the $5,000, any future earnings from that money will be taxed to him. Number 2. Prescribed rate loan. Instead of gifting money, you can lend it to your spouse at the CRA's prescribed interest rate. As long as your spouse pays you interest on the loan, the investment income they make from it will be taxed at their rate. You will have to include the interest they pay you as income on your taxes, but this strategy can still save you money. Let's see how this works. For example, you lend $100,000 to your spouse at a 3% interest rate. The investment earns 5% annually, so your spouse pays you $3,000 in interest, which you must report. However, any income beyond that, like the extra 2% or $2,000, is taxed in their hands. Number 3. Gift or loan for business. If you gift or loan money to your spouse for a business, the income from that business is taxed in their hands, not yours. This strategy can help reduce your taxable income while helping your spouse build their business. Now, it's important to note that attribution rules don't apply to business income. If your spouse uses the money to start or grow a business, the income from that business won't be attributed back to you. For example, if one spouse gifts stocks to another, any income or capital gains generated by that stock will still be attributed back to the person who gifted it. So, transferring assets to reduce taxes won't work here. Number 4. Pay your spouse a salary. If your spouse works in your business, you can pay them a reasonable salary. This income will be taxed at their rate, which could be lower. Plus, it allows your spouse to contribute to CPP and create RSP room for future retirement savings. Number 5. Split pension income. If you receive pension income and your spouse has a lower tax rate, you can split up to 50% of your pension with them. This can help lower your tax bill and avoid OAS clawbacks. It also allows both of you to claim the $2,000 pension income credit. Number 6. Contribute to a spousal RSP. By contributing to a spousal RSP, you can help reduce future taxes when you both retire. This strategy works even better if you retire before age 65 or if one spouse earns more than the other. It lets the lower-income spouse withdraw RRSP or RRAF money and have it taxed at their lower rate. Number 7. Transfer capital losses. If you have unrealized capital losses but can't use them, you can transfer them to your spouse. This works if your spouse has taxable capital gains and is in a higher tax bracket. To do this, sell the lost securities to your spouse at market value using the superficial loss rules. That's all for today. Thanks for watching this breakdown of spousal attribution rules. Stay tuned for more tax tips and strategies to help you save. Don't forget to like, subscribe, and hit the notification bell for our next video.